In this set of videos, we're going to discuss mutual funds and exchange traded funds. So as a blanket group, if you will, we could just refer to these all as mutual funds, a special kind of an investment. And we'll discuss the properties of how the companies themselves are run and the types of mutual funds that are available and some strategies. So a mutual fund is a type of an organization. It gets money from a group of investors and uses that to fund a portfolio of securities. So when you buy a share of one of these corporations, you are buying a proportionate amount of that investment. So essentially, it's sort of like a corporation. A corporation gets money from investors so that it can buy plant and equipment to run the business. A mutual fund is a corporation that gets money from its investors, and it takes that money and it purchases a portfolio of securities with a certain strategy in mind. Now, these started back in 1924. By 1940, there were a grand total of 68 of these, and by 2015, there are over 9,300 of them, and they have roughly 15.8 $15.8 trillion in assets under management. So now there's more mutual funds in existence than there are stocks. About 43% of all households owned mutual funds in 2014. And actually, I find that to be rather low, right? I mean, many companies provide mutual funds and things like that for their investors. So I find that 43% number to be pretty low, actually. Again, worldwide, there are over 79,000 mutual funds in operation. So it's obviously a very big kind of an investment vehicle. On domestic equity, about 42% of the assets under management here are what we refer to as domestic equity. We also have hybrids, combinations, if you will, of different kinds of mutual funds. So this is just a spectrum of how the world of mutual funds breaks down by thinking about strategy and the things that they invest in. So the concept of a mutual fund is it's referred to as pooled diversification. This is the idea of combining money in a group and achieving some form of diversification. And we've talked a little bit about this when we talked about our risk chapter. You know, when you combine assets together, especially if you do it strategically, you can achieve a fair amount of risk reduction in a portfolio. So each investor who owns shares in a fund then is a part owner of this fund's diversified portfolio. So mutual funds can be actively managed or passively managed. So a mutual fund manager, a money manager, can actually actively make changes, etc., within the mutual fund. And then there are passive funds where essentially they buy a package of portfolios and they follow those portfolios with certain guidelines in mind. So an example of a passively managed fund might be a stock index mutual fund geared to follow a specific stock index. So what are the major attractions, if you will, to mutual funds? First of all, you get portfolio diversification that is, quite frankly, for an average American, very difficult to achieve. A great deal of diversification due to our capital constraints. You get somebody that knows how to manage money, right? So we're going to actually pay somebody. Obviously, nothing's free. We're going to have to pay them to make good choices for us. The idea here, though, is that they don't make money unless we make money. So the more money we make, the more money they make. And also there's this ability to invest very small amounts. Once you have a mutual fund, you've purchased one, some mutual funds for as little as $25 a month, you can invest in a mutual fund. They provide services that we'll talk about a little bit later. Automatically reinvesting cash flows, keeping track of taxes. They have exchange privileges where you can move within a fund family. They're very convenient. They're easy to buy and sell. They're easy. Excuse me, man. They're easy to keep track of prices and performance. On the downside, they have transactions costs. Well, I have news for this textbook and everybody else. All investments have transaction costs. They have management fees, commission fees. You can find out the relative cost of this with something called an expense ratio. But all investments have costs, and all investments have varying returns. So although these are there, there's no doubt that these expenses are there, and there's no doubt that returns change over time, right? The idea here is that the textbook and many people try to downplay the usefulness of mutual funds with these statements, when in reality all investments have these same challenges. What I might also add is where they say here, that many mutual funds just keep even with overall stock market index. And quite frankly, that might be true. But the question that's just as important if you're thinking about a real investment type of a person, if you are, is that what is the risk of this? If you can get the same rate of return as the stock market, but you can do that with less risk, to me, that sounds like a good investment strategy that's taught in every investment course in the world, and this class certainly is no exception to that, right? So, you want to try to find ways to reduce risk. Consistently beating the stock market certainly is no easy task, right? Lots of people attempt to this, and many people don't succeed. So across a wide variety of funds, right, there's a majority of portfolio managers here, they say trail their benchmark. That is, they don't perform as well as the benchmark that they're attempting to replicate. There are a handful of funds, though, that do have spectacular returns. Again, they say most mutual funds don't meet those goals. Well, hopefully we'll see here in a second a graph that basically shows that, it's true that some don't beat their benchmark, but we need to understand a little bit more detail before we make these general statements. It says long-term returns from mutual funds have been substantial, but a good deal of those returns can be traced to strong market conditions and the reinvestment of dividends and capital. And yes, that's the point. That's the point of investing, right? You invest for the long term. You reinvest to get compound returns. So I'm not really sure what their point is here, although they just have basically described what a good investment vehicle will do. This particular graph I just found a little interesting. They look at from 2009 to 2014. And this was a pretty volatile time in our economy. But if you look at all U.S. equity funds, 74%, right, percentage of mutual funds outperformed by their benchmarks. So that means 74% of all U.S. equity funds performed less than whatever their benchmark was. And my point was that also means that 26% did outperform, right? 13% here, right? 12% here. real estate funds. This is a very volatile time for real estate funds, so it's not surprising that mutual funds didn't perform as good as some real estate index funds could be. Short-term bond funds, right? It says 49%. I mean, 51% of the short-term bond funds outperform the index. So I like this graph in that it makes their point, right, that many mutual funds don't beat their benchmarks. But I have more questions, right? Obviously, there are some that do. Maybe we should search for those. We also want to attribute and look at risk and how risk fits into these returns that they're talking about. So how are they organized? Essentially, a mutual fund is a corporation or a trust. A management company runs the daily operations. There's a money manager, right? There's an investment advisor. They're the ones that essentially buy and sell the stock. So this is our money manager. The security analysts are in this group, right? The traders are part of this investment advisor group. So really we have a company that runs operations, and then we have this advisor that does the actual trades. There is an entity or a part of the company that acts as a distributor. They help us sell the funds. There's a custodian. A custodian physically safeguards the securities that the company purchases. And essentially the end is a transfer agent. They're basically the accountant of the group. They keep track of the purchases and the redemption requests from participants. So this is a corporation that has operations just like any other operation. But we have separated it into segments, just like most companies are separated into marketing, operations, and finance. We have different functions that are handled by different components of the company itself. So there are two ways we can classify mutual funds. The first way we can classify a mutual fund is with something called an open-end fund. And quite frankly, this is what we talk about when you use the word mutual fund. And the closed-end fund, we'll talk about that here in a second, but a closed-end fund is when you're talking about things that might be referred to as exchange-traded funds. So open-end funds, they get regular infusions of cash from investors, and they use that money to purchase a portfolio of securities. So investors buy and sell their funds. Typically, that's directly with the mutual fund. There's no secondary market. So what that means is if you have mutual funds, you can't sell your shares of a mutual fund to another person. The technical word is the mutual funds are redeemed. They go back to the corporation. And a fund can issue an unlimited number of shares as investors contribute new money. So technically what happens is when you redeem your shares, when you sell them back to the mutual fund destroys those shares. So every time you buy shares, you're always buying brand new shares that have never been owned by another person before. Now, the net asset value is the value of all the securities of the fund divided by the number of shares. Now, the value of securities, of course, we have to take into account that there might be some expenses, but the value of the securities divided by the shares tells us what the value of each piece of pie, if you will, of the mutual fund. What is each one worth? With open-end funds, again, investors are free to withdraw their money anytime that they want. In fact, by law, this has to be done within 7 days of the request. One of the challenges that mutual funds have, one of the risks of being a mutual fund is what happens when many people are scared and they're trying to get out of the market and everybody wants to withdraw their money. Well, the mutual fund only has so much cash in the checking account. So this ultimately might force the mutual fund company to sell assets at the worst time when when the values are going down, but it's at the very worst time in order to fulfill these withdrawal requests. And again, they refer to this as being a fire sale, right? They're selling things that are good investments. They don't want to sell them, but they need the cash to cover the requests of investors. Some mutual funds will have a redemption fee if you sell the shares within a very short time frame, and usually this is 1 year. So if you buy mutual funds and then you try to sell those same mutual funds within the same year, there may be a redemption fee or a payment or a commission, if you will, in order to sell the securities or redeem them back to the mutual fund. Closed-end funds operate much like a corporation that you and I think of, right? It has a fixed number of shares. They don't regularly issue new shares. So when they sell shares, they typically only do it at the initial offering, right, in the very beginning, and then all subsequent trades are done in the security market, or the secondary market, just like common stocks are. Investment advisors don't have to worry about cash inflow and outflow because everything is done outside of the mutual fund. All the trading is done between investors. So the market price of these funds, though, is going to be different than the net asset value because supply and demand now is a piece of this. So really good mutual funds, since the demand for those mutual funds is high, their price might be actually above the net asset value. So they may be selling at a premium, something different than the net asset value. So it adds another level of investment analysis to understand the premiums and or the discounts and why they're happening. We talked about exchange traded funds. They're a special kind of a closed fund. They talk here about it being an open-end fund, but exchange traded funds typically trade like closed-end, right? They have some of both the characteristics, if you will, right? So they can typically, the big difference is that they will sell securities or issue securities more often, where a closed end only does it once, an open end does it whenever they want, has an unlimited amount. An exchange traded fund can actually determine when it wants to issue more shares. You can buy and sell these shares anytime during trading hours, right? You're actually buying them from an exchange. Typically, they have lower management expenses because the investment advisors aren't particularly active in the management of the funds themselves. So, in addition to having low management expenses, these funds typically also, since they're passive by their nature, they also don't have a lot of turnover. So there are some taxation is frequently offset until the ETF is sold. So essentially, when you sell an ETF, that's when the capital gains piece comes to light when you're trading these kinds of funds. If you think about mutual funds, one of the things we have to think about investing is what does it cost to buy the mutual fund? So in the mutual fund world, the commission is referred to as a load. So a load fund is a mutual fund that charges a commission when shares are bought. No load funds don't have a sales charge. They also refer to things as being low load funds, right? These they have a load, but they are typically a very low load, especially if you have large investments, right? They offer discounts. A back-end load would be a fee if you sell the shares, right? We referred to that earlier as a redemption fee. And then there are fees referred to as 12b1 fees. These are charged by some mutual funds to cover management and other operating costs. the thing when they say here, when they say some mutual funds, it turns out that most mutual funds, with if not almost all mutual funds, charge a 12b1 fee. So what we need to be interested in, what we need to understand is, what is the cost of purchasing a mutual fund and owning it, right? They make the point, they say no load funds don't charge a sales charge. So you may say, well, that's great. Why would I want to pay a sales charge? Well, that's because it's not the only charge. All right, a no load fund will typically have higher management fees than what a load fund might have. So we need to understand and be able to make comparisons between these fees. So what fees? There's a management fee. We pay this to the professional managers who administer the fund's portfolio. There are administrative costs. There's an exchange fee, right? Some funds charge this whenever you transfer money from one fund to another within the same fund family. Now that's not normal, but sometimes there are these other fees. The SEC requires mutual funds to fully disclose all their fees in a standardized, easy to understand format. So here's what this looks like. This is an excerpt from a mutual fund. So the maximum sales charge is 3%. What if you reinvest? What sales charges on reinvested distributions? None. So it doesn't cost anything to reinvest. Is there a deferred sales charge on redemption? That is, do you have to pay to sell these or redeem them back? None. Are there exchange fees? None. But there is an annual account balance if you have less than $2,500. So if there's less than $2,500 in this fund, you will be charged $12 a month in addition to the 3% sales charge on the value of the fund. The management fees, 0.45 is the management fee, and this particular mutual fund doesn't have a 12b1 fee, but it does have other expenses. So the total annual fund expenses is 0.65%. So that's less than 1% a year for them to manage your money and make decisions for you. Now what they provide, and this is in every single kind of a mutual fund you can think of, this is based on $10,000 investment, right? And they look at numbers for 1, 3, 5, and 10 years, and then you redeem at the end of those periods. So what would it cost for you to have this mutual fund throughout this time frame? And they also assume that it earns 5% per year. So really, it standardized the fund. So now we're only looking at what is the impact of these numbers up here. So for 1 year, it would cost you $364 to own this mutual fund. Again, it's a $10,000 investment. For 3 years, $502. 5 years, $651. For 10 years, right, it's $1,086. So think about it. Divide 1,086 by 10 years. So essentially, it's costing you about $108 a year to own this mutual fund. If you owned it just for 1 year, it would be $364 for the entire year. So not only can we make comparisons, but we also can see really that mutual funds are created to be a long-term investment. The longer you hold them, the lower the annual cost per year will be. So we'll continue this mutual fund discussion with more discussion about the funds themselves, services, and some strategies in another video.